You may think your business is profitable and still wonder whether there will be enough cash to cover payroll, rent, taxes, credit cards, software, utilities, and your own pay. That happens because profit and cash flow are not the same thing. Profit tells you whether revenue is greater than expenses over time. Cash flow tells you when money actually enters and leaves the business. A customer invoice may count as revenue, but until the customer pays, that money cannot cover this month's bills. And the balance in your bank account does not show everything already committed. Available cash does not always mean available to spend. This is A. Schultz Books, and I help small business owners turn their numbers into clearer, more confident decisions. The first step in cash flow forecasting is establishing a realistic baseline. Start with the cash your business actually has available today. Do not include unused credit, unpaid invoices, sales that have not happened, or revenue you simply hope will arrive. Next, list the payments you reasonably expect to receive, such as invoices, retainers, contracts, online sales, or other dependable inflows. Then identify the money already committed to leave the business. Include payroll, rent, utilities, insurance, taxes, debt payments, credit cards, software subscriptions, vendor commitments, and owner draws or owner pay. Also include variable expenses and known one-time costs such as renewals, repairs, professional fees, or a large purchase. Group these into fixed recurring expenses, variable operating expenses, and known one-time costs. The goal is not to predict every dollar perfectly. It is to create a working model that gives you more useful information than checking your bank balance and guessing. Once you understand your current position, ask whether your expected revenue is realistic. Many owners take annual revenue, divide it by 12, and assume each month will perform about the same. But most businesses have patterns. Review comparable months from previous years. Look for slow seasons, recurring customers, open invoices, signed contracts, and your sales pipeline. Also consider how long customers normally take to pay. A sale made this month may not become cash until next month. If payroll, rent, taxes, or credit card payments are due first, your business may still experience a shortage even though the sale is recorded. It can help to consider 3 revenue scenarios: conservative, expected, and optimistic. You do not need a complicated model. You need to understand how your cash position changes when revenue arrives later than expected or comes in below plan. If your business can only cover payroll under the optimistic scenario, that is a warning worth investigating. Historical patterns can also help you prepare for slower months. Past performance cannot guarantee what will happen next, but it can show you where pressure has appeared before. If revenue usually declines during a certain season, include that decline before the slow month arrives. That gives you time to consider a larger reserve, delayed purchases, lower recurring expenses, temporary changes to owner draws, or different hiring timing. Planning ahead does not mean expecting the worst. It means giving yourself more time to make a thoughtful decision. After estimating monthly cash inflows and outflows, calculate the projected ending cash balance for each month. The most useful number may not be your year-end balance. It may be the lowest projected cash point during the year. Identify the month when cash is expected to be lowest. Then compare that amount with the minimum cash target you want the business to maintain. That minimum target is not automatically zero. You may want enough cash available to cover payroll, essential operating expenses, a customer payment delay, an unexpected repair, or part of a seasonal slowdown. The goal is not simply to avoid a negative balance, it is to recognize when the business is moving outside the range you consider safe and manageable. If the projected balance stays above your minimum target, continue reviewing and updating the forecast. If it falls below the target, use the forecast as a diagnostic tool. First, ask whether the issue is timing. Sales may be healthy, but customers may pay after major bills are due. Large payments may be concentrated in only a few months, or expected revenue may be less dependable than it appears. That may lead you to review invoice timing, payment terms, deposits, recurring billing, or customer follow-up. Next, ask whether recurring overhead is too high. A shortage that repeats month after month may point to a structural problem. Software, subscriptions, debt payments, service contracts, and other fixed commitments can quietly consume more cash than expected. Review what may be canceled, renegotiated, consolidated, replaced, reduced, or delayed. Then ask whether one major decision is creating the shortage. This could be a new hire, equipment, expansion, inventory, a tax payment, an owner distribution, or an annual renewal. Instead of asking, "Can I afford this today?" ask, "What happens to my projected cash after I make this decision?" Finally, determine whether the issue is temporary or structural. A 1-month timing gap is different from a forecast that remains below your target for 6 months. A problem that appears during the same season each year may point to seasonality. A steadily declining balance may indicate that pricing, expenses, or the business model needs deeper review. This is where cash flow becomes more than a report. Good financial information should not just tell you what happened, it should help you decide what to do next. Your forecast may show that you need to build reserves, reduce recurring commitments, improve customer payment timing, delay a purchase, adjust owner draws, reconsider hiring, or speak with a financial professional. There is no single reserve amount that works for every business. Consider how far the projected balance falls below your minimum target, how long the shortfall lasts, how dependable expected revenue is, and what unexpected costs could arise during that period. The cash flow snapshot was created to organize this process into a repeatable 12-month view. It helps you map expected cash, recurring obligations, slower periods, warning months, and projected balances. It also gives you charts and visual indicators so you can see where pressure may occur and test decisions before they affect your bank account. It does not replace professional accounting, tax, legal, or financial advice. It gives you a practical way to understand your numbers, ask better questions, and recognize when additional support may be needed. You can find the cash flow snapshot at aschultzbooks.gumroad.com/l/cashflow-snapshot, along with other business planning workbooks designed to help you turn business numbers into better decisions. Subscribe for more practical explanations about cash flow, business health, and using financial information to plan what comes next.